Hello and welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I'm Mike Wahlberg, and I'm joined today by Dr. David Blanchett, CFA. David is the head of retirement research for PGIM DC Solutions, a unit within Prudential's investment management business, as well as an adjunct professor of wealth management at the American College of Financial Services. David also sits on the editorial board of the Financial Analyst Journal, Financial Planning Review, and the Journal of Retirement. David came to PGIM by way of Morningstar, where he was head of retirement research, and Unified Trust, where he led a similar group. With over 100 published papers to his name, clearly David brings a research focus to his work optimizing clients' retirement experiences. We're going to talk to him about his latest, Investment Horizon, Zero Correlation, and Better Retirement Portfolios. The study makes some interesting discoveries in regard to the impact of time and inflation on optimal portfolio construction and makes the case for, drum roll please, Commodities. Welcome to the show, David.
Thanks for having me.
So, David, what were the essential research questions that you set out to answer in this paper?
Well, it's funny. If I go way back in time, I want to do my PhD dissertation. One of my 3 papers was actually on this topic. It was on how does the optimal portfolio change if you look at different investment horizons, given the structure of investment returns. And I thought I might kind of dust off the research and the concepts and look at a few other angles of risk and time and use a different data set entirely to see if everything still holds. So the goal of this research was with a PGIM colleague, Jeremy Stempian, was to just look at, is it reasonable to assume that returns are random over time? And if you use these actual historical returns with their zero correlations, what would it mean for how you would change the portfolio that you might build?
Gotcha. And so you talk in the paper a bit about something called time diversification. So I wonder if you could explain that concept a bit and sort of what you found in terms of the various asset classes you looked at.
Yeah, so time diversification, I think, is one of at least the more misunderstood concepts that exist today. There's different perspectives, right, on how the risk of assets and investments change across time. One of the more common and I think misleading graphics that is used to talk about risk and time shows the distribution of compounded returns over longer time horizons. And what happens in those charts is that, if you look at the historical compounded return on equities over longer time periods, the geometric returns converge. And so you see the distribution is negative 30% to positive 50% in the first year, and it kind of collapses down over time. And so people will say, stocks, for example, will become less risky the longer you hold them. Well, we should never view risk in terms of the distribution of returns. It's the distribution of wealth. And for virtually every asset that exists, the distribution of wealth outcomes increases over longer time horizons. So what's really important is that every investment out there that I'm effectively aware of becomes riskier the longer you hold it. Now, we could do some different definitions of risk, but just if we just use standard deviation, the risk is increasing. And so I think what's really important is that I'm not trying to suggest here at all that somehow equities become safer in absolute terms over longer time horizons. But what's really important is how the risks across asset classes evolve. So again, the risk of all asset classes is increasing, but it does so at different rates. And the objective of the paper is to really understand this idea of, how do those rates change and how would combining them at different investment horizons affect this definition of an optimal portfolio?
So you're looking opposed to, usually we just sort of take a given input of what is the standard deviation for stocks, for bonds, and so on, and try to optimize based on that. The first step is you're not looking at how they interact with one another. You're looking at how they interact with themselves over time. Basically, that idea of autocorrelation of kind of what is the path of returns, as opposed to just taking it as a given. Is that accurate?
Yeah. So I presented this a few times, and someone's like, "Do you hate mean variance optimization?" I'm like, "No, I think it's actually great. I think it's a tool and a toolkit." Okay, but the thing about mean variance optimization, in most of the more common ways that we build portfolios today, you usually have assumed expected annual returns, you have annual risk levels, and you have correlations, right? And those are usually based upon annualized values, or you can, transform quarterly values to annualized values, whatever it is. Now, the problem with that is that it assumes returns are independent over time. It assumes that I can capture the essence of what it means to own different asset classes by just looking at what is the annual return, what is the annualized volatility, and what are the annualized correlations, right? What we're trying to do in this research is say, hey, wait a minute, like, what are these weird relationships that might exist kind of across asset classes and with inflation when you have a longer investment time horizon? So the idea then is to say, hey, like, let's actually look at the portfolios that you would build if you just use kind of those 1 year values. So just looking at individual calendar year returns and say like a 5 year investment time horizon. And like, long story short, whether you look at individual asset classes, larger portfolios, things do change over longer time horizons because of these serial correlations that are present.
Yeah, and that's like one thing I wanted to talk about a bit there as well is what the takeaways were on that. I mean, you had you had a table there that talks about the optimal equity allocation by country around the world, which is quite interesting. What did you find when you looked at sort of the actual historical returns versus taking away the effect of this kind of autocorrelation through bootstrapping? We'll get to that definition in a sec.
Well, I think it might be good to start there, but like, I think, for the listeners who are, following along and reading the paper as we speak, I think it's Exhibit 5. I've got it up here. I'm looking at. And here's the question again. It's okay. There's this kind of perspective that returns don't follow a normal distribution, right? That you can't necessarily accurately capture the skewness and kurtosis if you just, create a multivariate normal distribution. And so one way to test for serial correlation is to do what's called bootstrapping. And in this example, it's bootstrapping with replacement. And what we're doing in the paper is we're saying, hey, let's just say we had 150 years of returns for 15 different countries. We're going to take those 150 years, and we're going to run two different sets of optimizations. Okay, let's say we're focused on a 10-year time horizon. Okay, one, we'll take, the year, 1900, 1901, 1902, 1903, 1904, 1905, ... 10 years forward. Then let's do it again. So it's using the actual historical time series as it actually occurred. Another way to do it is to take those 150 years and just randomly reshuffle them. So I'm going to take, the return from the year of 1900, 1932, 1975, 1889, etc. That's bootstrapping. So what the key with bootstrapping is it actually it'll capture the average return, the average annualized return, the average risk level, and all these other effects, but it breaks the serial correlation.
Yeah, because you keep the means and covariance is constant through that, right? But then you just
correct.
reshuffle the deck as to how you got there.
Right, and so we reshuffle like 10,000 times. So we just a bunch of reshuffling to get back to like the exact, and it's not the exact, but it's a very similar return distribution. And so if serial correlation didn't matter, what you would find is that the portfolios were identical using the historical time series and the way it actually happened in bootstrapping. That's not what we find. What we find for, almost every country, I think 13 or 14 of the 15 we tested, was that the optimal allocation to equities increases as the investment horizon increases. And what that tends to suggest is that equities do kind of a mean reversion that you don't see historically in fixed income over shorter time horizons. And so kind of, what we saw is that, for a moderate risk aversion, and I won't get into the exact model, but we do what's called a constant relative risk aversion utility function for the analysis. We find that for a 1-year time horizon, the right allocation was about 50%. Now, it was very different across countries. It was like 10% in some countries, 80% in others. So when you use bootstrapping, that doesn't change no matter how long the horizon is. It's 50%-ish at 1 year, at 5 years, at 10 years, at 15 years, at 20 years. However, if you use the actual historical time series and the way that it took place, you go from, an average of like a 50% allocation for a 1-year horizon to about a 70% equity allocation for a 20-year horizon. So what we're seeing then is that the stocks start to kind of become more efficient versus bonds the longer you have to invest.
Yeah, that's because, again, so back to serial correlation, this idea that any given year's performance has some relationship to the year before or the year before. And so in this case, correlations of the equities are more, I guess, negative over certain time periods relative to T-bills and bonds. So it gives you that risk reduction in the sort of the traditional definition. If I got that right?
That is. And so, we run a series of ordinary least squares regressions in Exhibit 1. And so what that does, like, that's how you can test for autocorrelation. You can say, okay, I know the return of the investment this year, and I'm going to look at what the return was last year, 2 years ago, 3 years ago, 4 years ago, and 5 years ago. Now, if returns are random, there's no relationship there. Like, the return last year shouldn't matter for the return this year. But if you look at historical returns, this is very present in the US, it's less present internationally. What you see is that positive returns for bills and bonds tend to be followed by positive returns. And so it's kind of like risk is increasing. If the market goes up, it goes up by more. With equities, though, it's the reverse, where positive returns are followed by negative returns. So what happens then is that it makes the risk of equities, again, on a relative basis, declining over longer time horizons, because you have these kind of this, it goes up and it goes down, it goes up and it goes down, versus cash and bonds that have these, prolonged periods of positive or negative returns.
Gotcha. And one thing I just have to ask, because, looking at the time series, I know you go back to 1870 to 2020 in your reports here. And as a quick aside here, we had Ed McQuarrie on the show a few months back here, who, as you know, he was making some pretty bold claims about the performances and correlations of assets going back to 1792. Namely, that we can't really expect that equities will always outperform bonds, even over longer time frames. Did you have any perspective on that? What did you think about his work?
I totally agree, right? I think that this data set covers 115 years. It looks at 15 countries. And, what we found was that the optimal allocation varies radically across countries. But we also tested we did an analysis looking at, well, how does the optimal allocation to equities change when you eliminate the equity risk premium? So when you say, hey, stocks are going to have the same return as bonds on average geometrically, does it still make sense to allocate to them? Well, like, you see a little bit of an allocation for a 1-year horizon just because of the diversification benefits, but over longer time horizons, you can still see allocations as high as 30 or even 50%, even if they have the same return, because of the way that the kind of risk declines on a relative basis over time. So yes, I think that we obviously don't know what's going to happen in the future, and there's a very good possibility the equities premium could go to zero, it could decline, it could be negative. But I think what this is kind of suggesting is a higher level, you might get higher allocations to riskier assets when you think about how the returns of those riskier assets tend to evolve over longer time horizons.
That's interesting that there's value in allocated to, because I'm stuck in my mean variance analysis framework here, where you've got this idea of, if you take away that equity risk premium and you're still carrying the higher sort of absolute standard deviation calculate or definition of risk for equities, that there would be any allocation to equities if that was the case for the same return stream.
So that's Exhibit 7. So, like, even without serial correlation, we found that the optimal allocation was about 20% to equities for someone that would normally be 50%. But that increases to as high, this is for moderate subversion, to around 40% over a 20-year horizon. So even if stocks don't do very well, the ability to kind of be a longer-term investor, at least historically, still suggests that could be a meaningful portion of someone's portfolio.
So we're going to get to commodities next, but I wanted to take a stop off at the work you did on small and value factors. What did you find when you tested those?
Yeah, so we wanted to look at this from a variety of lenses, right? And so I would say, looking at the optimal equity allocation, like, that's beta, right? Anyone that knows portfolios know that kind of like small and value kind of round out the 3-factor model, right? The Morningstar style box. I think that, like, the notion of small value, it's just ubiquitous. Everyone knows about small and value. And so we said, hey, like, what are some other tests that we could do to see whether or not the benefit of owning different asset classes changes over longer investment time horizons? And, it's really important to note that, the returns of small and value have eroded significantly since they were kind of discovered, especially for value. Small has still done pretty well. But I think that similar to the previous findings, we found that the optimal allocations to both small and value increase over longer investment horizons. And again, even if you eliminate any kind of return differentials between the two. And why that's important, people often say, well, yeah, it makes sense to, own more equities the longer you have to invest because equities have higher performance. Well, it actually shouldn't matter what the performance is for a given risk level, your investment horizon. It only should matter in a well-behaved model if there's some kind of benefit from a risk perspective to owning the asset for some kind of longer horizon. And what we see in the data historically for the U.S. is that small and value both become more attractive over longer investment periods.
One of the things that the study spends a lot of time focusing on as well is the impact of inflation on optimal portfolio allocations. And that takes us to the crux of the study. That's the use of commodities within a portfolio. What did you find?
Yeah, so I would say that when we did this, it wasn't that we were trying to talk about commodities specifically. What we're trying to do is find an asset class that is kind of a quasi-real asset like real estate or infrastructure, has a relatively long time series to see how looking at actual historical returns would result in different allocations than assuming returns are independent. And we thought this was especially relevant for commodities because, over the last decade, I've had lots of conversations with investment professionals that say, why would I ever own commodities, right? Commodities historically have had stock-like risk and bond-like returns. In Exhibit 10, in the paper, we show the historical return and risk levels of, bills, bonds, commodities, equities, and inflation. What you see historically is that commodities have had a similar risk as equities, both around, say, 18%. But commodities have underperformed equities by around 600 basis points, right? So right there, if you're someone that builds portfolios, it's one thing in the early analysis to say, hey, I'm going to equalize the performance of stocks and bonds to see if we get an allocation. But in this example, what you see is that, again, commodities have the same risk, but have underperformed by 600 basis points. So most people...
That's a pretty big hurdle.
That is a massive hurdle. That is most people, they would stop there. So if you look at forward-looking expectations, whether it's, we do some within PGEM, if you look at kind of the aggregated CMAs across the board, usually people think commodities will do, have similar risk to large cap equities and around 200 to 300 basis points lower return. Okay. Historically, it was 600 basis points. And so right there, someone would say, well, David, I can draw a line here, commodities as well beneath it. Why would I ever allocate to commodities? Well, one thing that you see when you use historical returns is that, you can't really capture the inflation hedging benefit of certain asset classes using calendar year returns, right? Inflation doesn't move very well if you just look at annual calendar year returns and assume each is independent. You've got to kind of look at asset classes for longer periods, for a 5 or 10 year, to really kind of capture how well the asset classes do as a quasi-inflation hedge over longer time horizons. And that's where commodities really starts to shine. So what you see is, over longer time horizons, cash, or especially bonds, becomes a lot less attractive, and equities and commodities become more attractive. And so we go from optimizations where, if you ignore inflation and you focus on a single year time period, you never get an allocation of commodities no matter what your risk target is. So it's 0% across the board. However, if you focus on, say, a 10-year investment horizon and you incorporate the risk of inflation, you could get allocations as high as, say, 20 to 25% for a moderately risk-adverse investor. And so to me, the key here is if you, structurally, if you just say, hey, I can see this, historic quasi plot of return and risk, never own commodities. But if you understand kind of how it can be a diversifier with equities and bonds over longer time horizons, it just makes a lot more sense. And so I think that, to me, what this suggests is that, investment professionals who aren't utilizing commodities at all in portfolios, they might not be accurately considering the risk of commodities in an overall portfolio, especially over a longer investment horizon.
It's interesting because I mean, obviously, we're just coming or working our way through really hyper. It's not exactly hyperinflation, but higher than we've been used to levels of inflation here in the last couple of years. But if you tried to make this argument 3 years ago, they'd be like, "Well, inflation's 2% forever." That's all anybody can remember, right? So, how long does the time horizon have to be for this to make sense? Assuming that we've got a surge in the 70s and early 80s, we've got a surge in the that's kind of like every 40 to 50 years when this matters. I mean, I guess it's impossible to know when you need this hedge, and you need it, you need it in place before that happens.
Well, that's just it. I mean, you typically only wanted to own commodities like after it's too late to realize their benefits. We saw that kind of in 2022. I mean, I think they aren't necessarily for someone that has a 1 year investment horizon. I think that and again, I would argue that almost every investor has at least a 5 year horizon. And for those investors who are thinking about allocating to risky assets, I think that commodities deserve at least consideration. I'm not suggesting that you put, a quarter of the portfolio in them, but I think, thinking about real assets is really important, especially for retirement portfolios. I think that, my title is head of retirement research. I think a lot about retirement, and inflation is a really big risk for investors that have to plan for a retirement that could easily last 30 years. And therefore, I think, to me, what the key is not necessarily pulling money out of equities. It's pulling money out of fixed income into commodities, or some of both. You're going to source it half from bonds, half from equities, because it's true that commodities are a lot riskier than bonds. They may have bond-like returns. They can be a very powerful diversifier in an overall portfolio, especially if inflation is high. And here's the thing: inflation is not high. It's actually kind of an ideal environment to be in for retirement. So I mean, if we focus on like the objective is to have income for life adjusted for inflation, yes, commodities won't do as well if inflation is lower, but if inflation is lower, you have a higher likelihood of accomplishing your goal. So what it's doing is it's kind of helping you hedge the outcome, which the outcome for most folks is to have income for life with some kind of inflation adjustment.
So it's really more of a strategic allocation, not something you do tactically. So that was going to be my next question: is it too late? Is the horse out of the barn at this point? Obviously, we're flirting with 3% inflation again. So you make an allocation based on a 30-year time horizon and say that there's value in having some in commodities.
Yeah, I mean, I think there's a lot of evidence that suggests that market timing is really, really difficult. I think that I think it can be worthwhile to make slight tweaks to portfolios on the margin, but I just think that having a reasonable allocation to real assets is really important. Broadly, I would define that as real estate, commodities, and infrastructure. You could throw in other things too, but I think the key is not viewing them. You should never view the risk of an investment in isolation, right? It's all about what are the covariances, how does it affect overall, risk and wealth expectations, and just in acknowledging that I'm buying this as a pretty cheap hedge. If inflation becomes material, that part of my portfolio should do relatively well.
So have these findings impacted your allocations at PGIM?
So I would say that like we've, it's ironic, like we've kind of been doing this for a long time. We have, I'm a portfolio manager on our Target Date series. Well before I joined, they had, one of the highest, if not the highest, allocations to real estate and commodities of any of the Target Date providers that exist. We just released some retirement spending portfolios in April that could have the highest allocation to alternatives of any balanced portfolios that exist today. So I think that we're not saying that you shouldn't own bonds, you shouldn't own equities, but I think my goal is to say, hey, like if you're trying to accomplish a goal, build portfolios explicitly designed to accomplish that goal, thinking about how the risk of assets evolve over time. And it's just an simplification to assume that returns are random. They're not. So since we know that, how do you kind of build strategic portfolios that better account for that?
So we're coming to the end of our time here, unfortunately, David. I wonder if we could cast your mind back to your first job in the industry. If you could go back and take yourself for coffee on that first day, what key piece of advice would you offer yourself?
Well, so it's funny. I was really focused on being a financial planner. I was actually doing internships in high school. I actually took the CFP when I was 21, and I just wasn't aware of all the different positions that are available in our industry today. I'm really glad to have that kind of personal finance background, to have worked with people to solve problems, because people aren't as rational as a lot of the economic models might lead us to believe. But, maybe it would have been to kind of better understand what are all the different ways that you can help people accomplish their goals. And, I would say I enjoyed being an advisor, but I would say I enjoy doing this kind of research and building these strategies a lot more. And I wish I'd gotten into it sooner. So this kind of maybe a better awareness of what else was out there would have been good for me at a younger age.
I've been speaking today with Dr. David Blanchett, head of retirement research for PGIM DC Solutions and co-author of Investment Horizon, Serial Correlation, and Better Retirement Portfolios, available now on the CFA Institute website. Thanks so much for coming on the show today.
Thanks for having me.
I'm Mike Wahlberg, and this has been The Enterprising Investor.